No, they don't. It's just this one.
Go fly.
Should have checked that first. Good evening and welcome. Bonsoir, bienvenue.
Good evening and welcome.
2018 Annual General Meeting. My name is Marilyn Quinn, and I'm the chairperson of the Board of Trustees of the New Brunswick Public Service Pension Plan. The board has purposely hosted our meetings around the province, and we're very pleased to be here in Bathurst this evening. Thank you for joining us, whether you're here in person or if you're watching this meeting online this evening. First, I'd like to review a few housekeeping items. This evening's presentations will be delivered in English and French, and we have simultaneous translation in both languages. For those of you here in the room, if you need translation, we have some devices over here, and I encourage you to get them at this point. And for those of you who are joining us online, you have the option of selecting the language of your choice as indicated on the screen. This evening's meeting is being recorded, and the video will be available on the plan's website in the coming weeks. I'd also like to note that the 2017 annual report is available in hard copy this evening and is available online at vestcor.org/NBPSPP. And I think those of you in the room were given copies when you came in tonight. Before we go any further, I'd like to introduce the people with whom I'm sharing the stage this evening. First, our presenters. Eve Plord is a partner with the plan's actuarial firm, Morneau Chappelle. Eve will provide us with details relating to the plan's most recent actuarial valuation. Next to him is John Sinclair, the president and CEO of Vestcor, which is the plan's investment manager and administrator. John will provide us with an overview of the investment and administrative services outcomes for the plan of 2017. Secondly, I'd like to introduce to you the trustees who are on the board. Leonard Lee White is the vice chair of the board. He's a chartered financial analyst, and he's the Assistant Deputy Minister of Finance Treasury Division and has many years' experience in the public service, providing pension plan investing and risk management advice to governments and boards of trustees. Denise Pinette is a certified professional accountant currently employed as a financial liaison officer with the Department of Education and Early Childhood Development. Catherine Greenbank is a retired member of the NBPSPP. She's also a certified professional accountant who retired from Service New Brunswick. She's also worked with a number of other large firms throughout Atlantic Canada. Ross Galbraith is the business manager of Local 37 of the International Brotherhood of Electrical Workers, and he's also a representative for Canada on the IBEW International Executive Council, where he's a trustee of the IBEW Pension Benefit Fund. Sebastian Duchesne is the Dean of Faculty of Administration at the University de Moncton and Professor of Accounting. Sebastian is a certified financial analyst and a certified professional accountant and has professional experience in auditing. Susie Prudag is the president of the New Brunswick Union. She's also a trustee on other pension boards, and in addition to a role as the national vice president for the National Union of Public and General Employees. Odette Robichaud is a court stenographer and the president of CUPE 1830 and CUPE Regional and the executive member of the New Brunswick Division of CUPE Locals. We're also pleased to have two observers on our board. Lee Sprague holds a law degree from the University of New Brunswick, and he provides legal advice and representation to the New Brunswick Union and is involved in many committees and working groups. Bill Murray just recently joined our board as an observer in March of this year, and he's the facilities supervisor with the New Brunswick Community College and the president of CUPE Local 5017. One trustee was not available to be with us this evening. He had a prior engagement and he's actually out of the country. Mark Cadet is the Assistant Deputy Minister responsible for strategic services with the Department of Transportation and Infrastructure. Mark has extensive employment experience in administering pension plans and providing pension policy advice. For those who don't know me, I'm Marilyn Quinn, and I'm a retired registered nurse and the past president of the New Brunswick Nurses Union, a role I served in for 12 years. I've been a trustee on this plan for about 5 years, and I also serve as a trustee on another shared risk plan since 1998. As you can see, the board has very diverse backgrounds, providing us with strong board composition. It's also important to note that each of us has been appointed to the board by the provincial government and the following unions: the New Brunswick Nurses Union, the New Brunswick Union of Public and Private Employees, Local 37 of the International Brotherhood of Electrical Workers, and the Canadian Union of Public Employees. Several of us are members of the plan. Even though we've been appointed by the individual groups that I've outlined, each of us must always act in the best interest of the plan and its members, always when we're administering the affairs of the plan. Failure to do so could result in disciplinary action or revocation of our appointment to the board. To learn more about our backgrounds, our biographies are in the annual report, or you can go on the Vestcor site to the plan link. Now I'd like to move on to our first presentation, but a quick reminder, if you do have any questions this evening, we would like you to pose them during the question and answer period when Susie Prudag will host after the two presentations. At this time, I'd like to welcome Eve Plord to present her 2017 actuarial valuation results. The actuarial valuation is an appraisal that's conducted annually to determine the funded status of the plan. Eve will also provide us with some details regarding how a plan member's pension is composed from their own contributions to the employer's contributions and through the investment returns. Welcome, Eve.
Merci beaucoup, Marilyn.
Thank you so much, Marilyn.
Today I'll present in French. However, if you do have questions in English during the question period, it'll be my pleasure to answer you in English.
My name is Eve Plord. I'm an actuary with Morneau Shepell, and I'm very pleased to be here with you tonight to walk you through the results of the most recent actuarial valuation of the New Brunswick Public Service Pension Plan, or the plan, as of January 1st, 2018. I will provide you with the various highlights of the valuation, starting with a summary of the membership in the plan. I will briefly review the plan assets, the main economic assumptions used for the valuation. I will discuss the financial position of the plan, as well as review the risk management test results that we track. I will also take the time necessary to review the cost of living adjustment that was awarded by the trustees for January 1st, 2019, how this affects you either as a retiree, but also as an active member. And finally, I will spend some time to review how early retirement reductions are applied to the accrued pensions of those who retire before the age of 65. Membership. The plan has just over 18,000 active members who are currently contributing to the plan and accruing service. Active members earn on average $69,600 a year and have an average age of about 47. The plan also has about 3,800 deferred vested members who no longer accrue service in the plan, but they have not yet started a pension either. These members have left their money in the plan and will start to collect pensions when they reach retirement age. There are also just over 16,000 retirees who are currently being paid a monthly pension from the plan, and this number also includes survivors of deceased retirees. On the asset side, the pension fund started the year with assets of over $7.2 billion. Members contribute to the plan on average 8.25% of payroll of their salary, which represents about $97.3 million in 2017. The employers contribute 11.25% of payroll in regular contributions, plus additional temporary contributions of 1.25% of payroll, for a total of 12.5% of payroll, representing $146.5 million in 2017. The investment return was $559 million, which is a rate of return of 7.81% for the year. John will talk more about that performance for 2017 in his remarks. However, from an actuarial perspective, it's always good news when the investment return in any year is higher than the assumed rate of return used to calculate the liabilities of the plan. This rate, as we'll see a little later, is 4.75% per annum for the plan. So the rate of return of 7.81% exceeded the rate used to calculate the liabilities by just over 3% in 2017. This additional return serves to further secure the benefits for current and future generations. When we subtract benefit payments of about $378 million and expenses of $14 million for the year, we get a market value of $7.65 billion of assets at the end of 2017, so a net increase in the asset base of over $400 million in 2017. Now, where does each dollar of benefits paid come from? It's important to note that investment returns are the most important source of funds for a typical pension plan. Over the long term, 80% of the funds used to pay pensions come from investment returns. The other 20% come from member and employer contributions. It is therefore very important to ensure that investment returns be achieved in as consistent and secure a way as possible. In order to be able to determine the financial position of the plan, we need to compare the assets of the plan to its actuarial liability. The actuarial liability is a representation of how much money we believe should be in the fund at the time of the valuation in order to pay up all the benefits that members have accrued up to the date of the valuation. In order to calculate the liability, we need to make assumptions as to what the future may hold for the plan. Future expected investment returns, retirement patterns, future mortality levels, among other things, must be taken into account in order to determine how much needs to be set aside to provide for the benefits payable from the plan. In order to discount future cash flows expected from the plan, we use a discount rate of 4.75% per annum. This is a very conservative assumption of expected investment returns for the future. In fact, we estimate that the plan will be able to reach this level of investment return of 4.75% over 75% of the time. On average, we estimate that the fund can be expected to earn about 5.9% per annum over the long term. This level of conservatism in the discount rate ensures that more often than not, plan investments should generate extra funds compared to the discount rate assumption, as it did in at least the 4 last years. These extra funds generated from investment returns in excess of 4.75% can then be used to further secure benefits and to provide cost of living increases in the future. We do not make a specific allowance in the liability for future cost of living increases that may be granted by the trustees. Future cost of living increases are granted by the trustees when the financial position of the plan allows for it, and it is only added to the liability once it is granted. So by using these main economic assumptions that I just reviewed and other assumptions related to the expected retirement age and mortality, we obtain the liability for the plan by projecting all expected future cash flows from the plan for the benefits earned to the valuation date and discounting those future cash flows to today using the discount rate. The liability, therefore, represents our estimate of how much money should be in the pension fund today to pay the benefits accrued to the valuation date for the lifetime of the current members and their survivors. When you compare the liability to the assets of the plan, if the assets are higher than the liability, you have a funding excess. But on the other hand, when those assets are less than the actuarial liability, you have an unfunded liability or a deficit. In the case of this plan, we have assets of over $7.6 billion at January 1st, 2018, and liabilities of about $6.8 billion at the same date, resulting in an excess of $821 million at valuation date. This excess was $585 million at January 1st, 2017. One of the main sources of increase in the funding excess year over year comes from the investment return for the 2017 of 7.81% compared to the previous year, and compared to the discount rate assumption. The normal cost of a pension plan represents the cost of the benefits that are accruing on behalf of the active members of the plan during the year following the actuarial valuation. The normal cost for the plan stands at 12.4% of payroll. In contrast, contributions being remitted to the plan every year by the members and their employers apply to about 20.75% of payroll, which means that there's a total of about 8.35% of payroll being remitted to the plan in excess of the cost of accruing benefits. The same way expected investment returns in excess of our 4.75 discount rate assumption provides a security buffer. This excess of contributions over the normal cost will also be used to strengthen the financial position and increase the security of plan benefits for all members, and will also assist in providing cost of living adjustments to both active members and retirees alike. Over the next 15 years, it is expected that the plan will receive about $1.2 billion in such excess contributions that will serve to strengthen the financial position and provide cost of living adjustments. An important financial measure under the plan is what we call the 15-year open group funded ratio. This ratio is equal to 129.8% at January 1st, 2018. The trustees use this ratio to determine which actions they must take or consider taking every year when valuation results are available. This ratio is therefore used to determine if a cost of living adjustment can be granted and how much can be granted. This ratio will also be used to determine if member and employer contributions can be maintained at their current levels or if they must be reduced or increased. It will also be used to determine if benefits can be maintained or if they must be reduced. In order to calculate the open group funded ratio, the market value of assets is increased by the value of excess contributions expected to be received over the next 15 years. The sum of the assets and excess contributions is then divided by the actuarial liabilities at the valuation date. You could say that this ratio is a quick way to determine where the plan might be in 15 years if assumptions are realized. At January 1st, 2018, the open group funded ratio of the plan, as I mentioned earlier, is 129.8%. Because the ratio is greater than 100%, it means that we estimate there will be enough money being contributed to the plan over the next 15 years, in addition to the assets currently in the fund, to provide for all the benefits payable for the lifetime of members and retirees. Not only is there enough money, but the ratio being at 129.8% means that there will be, in accordance with our estimates, 29.8% more money than required to provide benefits. Therefore, in accordance with the funding policy for the plan, a portion of this excess can be used annually to provide cost of living adjustments. I will review the cost of living adjustment granted for this year a little later. But for the moment, let's look at the risk management tests Every year, the plan conducts stochastic analyses to determine if the plan meets certain legislated risk management tests. In order to conduct these risk management tests, we simulate 2,000 future economic scenarios over a period of 20 years. The first risk management test involves calculating the probability that base benefits under the plan will not have to be reduced over the next 20 years. On that basis, the plan scores a 98.95%, which means that in 98.95% of cases, we do not expect to have to reduce base benefits payable from the plan. This score exceeds the minimum of 97.5% mandated by the Pension Benefits Act. Because the plan meets this test, it can continue to provide cost of living adjustments to all members and retirees in accordance with the funding policy. The second risk management test involves the calculation of the average cost of living increases that can be expected to be provided under the plan over the next 20 years. This calculation results in an average of 86.3% of the increase of the Consumer Price Index, which is a measure of inflation in Canada. Those risk management test results are very positive. They reassure us that there is only a very low probability that base benefits could be reduced in the future, and that there is a very high likelihood that cost of living adjustments are going to continue. In addition to the risk management tests, you can also get some reassurance that the province is guaranteeing that it will protect benefit levels that existed at December 31st, 2013, just before the conversion to the public service pension plan. This means that in the unlikely event that trustees would have to reduce benefits under the plan, the province will ensure that you never get less than the benefits you were receiving or had accrued at December 31st, 2013. Now, on this slide, you see how we expect the open group funded ratio to evolve over the next 20 years. Every ratio shown on the graph is in fact the average of all ratios for our 2,000 economic scenarios for that date. The ratios shown at each future year includes the value of the cost of living adjustments that would be granted by the trustees up to that point. You can see here that even with the granting of cost of living adjustments, it is expected that, on average, the financial position of the plan, as measured by the ratio, will continue to improve over time from its current level of 129.8% to over 144% in 20 years. This projection revealing an expected increasing ratio reassures me that the design of the plan is such that chances of success in the future are on our side. The road may be choppy, but we know that there are margins built within the plan to absorb such future shocks, such as the excess contributions being remitted year after year, as I've already mentioned, and the use of a conservative discount rate of 4.75%, well below the expected investment return on assets. The presence of these margins is reassuring and is in fact what results in a projected open group funded ratio that is expected to increase over the long term. I will now address the cost of living adjustment awarded by the trustees for January 1st, 2019. Every year, based on the financial position of the plan, the trustees have to decide if a cost of living adjustment is to be awarded. They cannot award more than the full increase in the CPI, the Consumer Price Index, which is a measure of inflation in Canada. For January 1st, 2019, the increase in CPI is equal to 1.88%. This CPI figure is the average increase in CPI over the 12-month period ending June 30th, 2018. Given that the open group funded ratio is at 129.8%, the trustees could award the maximum amount of 1.88% effective January 1st, 2019. This cost of living adjustment will have a cost of $121.6 million, which is split amongst the various groups of members as follows. About $43.2 million will increase active members' benefits. $74.1 million is will be used to increase retirees' pensions, and $4.3 million is used for deferred vested members, for a total, as I just mentioned, of $121.6 million. Although not on the slide here, it is interesting to note that given the funded status of 129.8%, the trustees could have awarded a cost of living increase of over 4% if inflation in Canada had been that high last year. Given the more recent CPI figures published by Stats Canada, inflation over the next year could be in the range of 2 or 3%. At its current funded level, the plan can continue to provide full CPI indexing, provided CPI stays below 4%. Let's now calculate the impact of a 1.88% cost of living increase on a typical new retiree. In the example presented, we have a new retiree of the plan at January 1st, 2018, at the age of 60 years old, with a salary at retirement of about $68,000 and 30 years of service. This new retiree can expect to receive a total of about $37,000 per year when we include his lifetime pension and bridge benefit. This new retiree would get a cost of living adjustment on January 1st, 2019 of $696 per annum, which would increase his annual pension to $37,696 per year, effective January 1st, 2019. This increase of $696 represents a 1.88% increase to his annual pension. Now, let's calculate the impact of the same 1.88% cost of living increase on a typical active member. Let's assume our typical active member is 58 years old. He earns $69,000 of annual salary and has 25 years of service on January 1st, 2018. Such an active member can expect to have earned about $25,000 of annual pension for his or her service before the conversion date of January 1st, 2014, and a total of $5,000 for the 4-year period after the conversion date, for a total accrued pension at January 1st, 2018 of $30,000. This $30,000 will be payable when they retire. This active member would get a cost of living adjustment of 1.88% applied to both the portion of the pension accrued before and after the conversion, which increases his pension accrued before January 1st, 2014 by $470 and his pension accrued after January 1st, 2014 by $94. This member would also receive additional accrual of about $1,380 for his service in 2018, for a total accrued pension at January 1st, 2019 of $25,470 per annum for their service before the conversion date, and a total of $6,474 for the 5-year period after January 1st, 2014, for a total accrued pension of $31,944 payable at the time of retirement, before adjustment for early retirement. This example gives a glimpse of the importance of cost of living adjustments, not only for retirees, but also for active members. In fact, we have determined that in a plan which is able to provide cost of living adjustments over the career of an individual, it can represent 20 to 25% of the total amount of pension at the time of retirement. Now, let's assume our same typical active member wishes to retire early on January 1st, 2019. We have to determine the reductions that will be applied to his pension upon early retirement. Early retirement reductions are applied to take into account the fact that members who decide to retire early will receive their pension for a longer period of time. By applying a reduction, it ensures that the cost of providing early retirement under the plan is either partially or entirely assumed by the member. You will have noticed that we show the portion of the pension accrued before January 1st, 2014 and the portion of the pension accrued after January 1st, 2014 separately. This is because different early retirement reduction rates apply to each portion of accrued pension. For the portion accrued before January 1st, 2014, the accrued pension is reduced by 3% for each year that the early retirement precedes age 60. If retirement is after age 60, of course, no reduction is applied. For the portion accrued after January 1st, 2014, a reduction of 5% for each year that early retirement precedes age 65 is applied. So in our example, our member is 59 years old at the time of his or her retirement, and therefore this represents 1 year early for purposes of the pension accrued before January 1st, 2014, or a 3% reduction. For the portion of the pension accrued after January 1st, 2014, it represents a period of 6 years early, and therefore a reduction of 30%, or 6 years at 5% per year, which gives 30%. After application of the reductions, which are permanent, the member would get a pension of $24,706 for his service before January 1st, 2014, and $4,532 for his service after January 1st, 2014, for a total pension of $29,238 per year. So thank you very much for your attention, and I do hope that you found this information interesting and useful. I will remain available for the question period.
Question period. Thank you. Merci.
Thank you, Eve. As a board, we were very pleased with the actuarial valuation, and more specifically with the positive returns that allowed us to approve the cost of living adjustment. And as Eve said, the 1.88%. Active and deferred members in the plan will have this applied to their benefits earned up to the end of to December 31st of 2017, while retirees will see this 1.88% applied to their pension benefit as of January 1, 2019. Some of you may be aware, I know we did put it in a newsletter that went out earlier in the year, that together with the province and the New Brunswick Investment Management Corporation, which is now known as Vestcor, and certain unions, sorry about that. The board has been named as a defendant in an action seeking, among other things, damages from the fund for alleged breaches of trust and contract and payment of the plaintiff's legal costs from the fund. There's a separate legal action against the province where the plaintiffs have indicated that in the event that the province does not pay their legal costs, then they would be seeking your pension fund to pay those legal costs. From our perspective, the sole purpose of the fund, your pension fund, is to provide pensions and pay costs relating to providing those pensions. The board has retained legal counsel and is defending itself and the fund from paying damages to the plaintiff's legal costs. Should there be any developments, we will continue to keep all members updated through our newsletters. And the newsletters are about semi-annual, and you do get those electronically, and the old ones are available on the Vestcor website. As we move into our 5th year as a shared risk plan, we felt it would be valuable to provide you with an overview of the results of the plan over the past 4 years since its conversion to a shared risk plan. To begin this presentation tonight, Leonard Lee White will provide a refresher of the plan and its key policies, after which John Sinclair, the President and CEO of Vestcor, the plan's investment manager and administrator, will provide an overview of the long-term results. Leonard?
Thank you very much, Marilyn, and good evening. As Marilyn has mentioned, this is our 4th annual general meeting, and at each general meeting we have had an opportunity to discuss the plan, its performance, and as well look at the actuarial results to determine our ability to continue to pay cost of living and the base benefits. We also thought this would be a good opportunity to explain once again what the board does and what some of the other participants in the plan do. It's some of the information Eve has already touched upon, and I know John will also touch upon it in his presentation. So some of what I say here is a bit of a bridge between the two. As mentioned before, the most important thing here is that the plan is managed in a way that provides a secure and sustainable pension to all the members upon their retirement, as the plan was designed to perform. And in order to do that, there is a focus, it's a risk-focused approach that Eve has already gone through the two primary risk management measures that assist in ensuring that we can deliver these high degree of benefits into the future with some certainty, and furthermore, that contribution rates remain stable into the future. With that, this focus on being able to pay and secure the base benefits, there are a number of things that are in place to ensure this. Certainly the actuary provides a lot of the advice, but it also gets into some of the things that I'd like to talk about in terms of the investment policy that we work with annually as a board and register any changes to this investment policy. And we work closely with Vestcor on that and various scenarios, as well as with the actuary to see how this could impact the performance of the fund into the future. Some of the documents that are used that established the plan have very clear guidelines for us to follow in terms of contributions and how benefits are calculated and paid, and as well as Eve has described, how indexing is achieved and paid into the future. And one of the most important things, and I think this annual general meeting feeds into it, is there a clear and consistent disclosure to plan members. And that's done through the annual general meeting, but also our annual report, semi-annual newsletters. And for some of you that are aware, we now have a new and enhanced website through Vestcor. And a lot of information is posted there, and I encourage members to go there to get a number of questions answered or to learn more about the plan. A couple of other things that are notable. This plan is regulated. It's regulated in two ways. The first is it's registered with the New Brunswick Pension, under the New Brunswick Pension Benefits Act, and it's under the shared risk section, which is part 2 of that act. And there are a number of attributes that we must follow, and I'll talk about that in a few minutes. Secondly, we also are required to file under the Federal Income Tax Act. We're registered under it, and we must file certain information on an annual basis to maintain that registration. As alluded to earlier, there are a number of governing documents that we must adhere to. There is a plan text. Again, that is available online. There's a funding policy that tells us what to do in the event that the plan is in surplus or in the event that it's in deficits and how we must react to that. And lastly, there is the investment policy that I referred to earlier that is very much a risk-focused investment policy. Now, the plan text itself and some of the other documents were developed when the plan was established by the parties, the governing parties. And as Marilyn alluded to earlier, the governing parties are the province of New Brunswick, as represented by the Minister of Finance, and the named unions that she referred to earlier on that are contained again in the plan documents. Major changes to the plan can only occur with the agreement of the parties. However, there are other changes that can be put into effect that are of a more operational nature that the board can make those changes, but has to file any changes with both the Superintendent of Pensions and the Canada Revenue Agency. So the Board of Governors, or the trustees, if you will, are appointed, as Marilyn alluded to earlier, by the parties. However, once we're here, again, we have a fiduciary responsibility to the plan, not a responsibility to the parties that appointed us. We are appointed for fixed terms on a staggering basis now, and we can only be removed for not performing our duties, and I believe only removed by the Superintendent of Pensions. Again, the governing parties put us there, but once we're there to act in the interests of all plan members. And as part of that, we're responsible for administering according to all the governing documents, and importantly, the investment policy, since it very much defines the risk tolerance of the plan. We must work closely with our fund manager and actuary and implement that investment policy. In terms of the more day-to-day management, the board originally was required to employ the New Brunswick Investment Management Corporation for a fixed period of time to invest the funds, as they had been investing the plan assets previously. And furthermore, the Pension and Employees Benefit Division of the Department of the Province of New Brunswick was retained to do the administration. Now, since that time, those two organizations have been transformed, and I think John will touch on that a little later in his presentation. Again, after the plan was established, the board approved the investment policy. We have to review it annually. That's a requirement, and any changes we file. We have the responsibility to award COLA as the plan is able to under the terms of the funding policy. And on a quarterly basis, we monitor the activities and the results of the pension fund, of the fund manager, and the fund administrator. And as well, in assisting in this, we have annual valuations conducted by the actuary, and as well, we have auditors coming in to audit various aspects, and again, John may touch upon that. So, with that, I will turn the podium over to John to talk about some other matters that pertain to your plan.
Okay, thank you, Leonard, and good evening, everyone. It's my pleasure to be here this evening to talk about what the services that Vestcor has brought to your plan during 2017. To open the discussion, though, I thought it may be best just to sort of remind you exactly who Vestcor is, and Leonard did talk or introduce that a little bit. Vestcor is an entity that was created over the last year and a half to bring the New Brunswick Investment Management Corporation, which was a crown corporation that managed the investment assets of a number of public sector pension plans, and the Department of, from the Department of Human Resources of the Province of New Brunswick's Pension and Benefits Administration Group, to bring those two entities out of government and have them be formed as private, not-for-profit companies owned equally by your plan and the teacher's pension plan. And they're owned technically through an entity called Vestcor Corp, which I won't spend a lot of time on here this evening. However, I will point out on the website vestcor.org, which contains the information of your plan and a significant amount of detail around Vestcor itself, has a tab that does provide a lot of information on Vestcor Corp. It has a diagram that outlines the structure of that entity. It has a copy of the members agreement for those for the two owners and the entity. It also has the financial statements, and for the first time this year, a brief annual report of the activities of that organization. For those who are interested in the detail, please feel free to access that information on the website. Vestcor itself is an entity that has about 140 professionals who manage investments and administer pension plans and benefits. We are based here in the province, located in Fredericton. From the investment side of things, we manage $17 billion in assets for about 9 public sector client groups. So obviously your plan is one of the bigger ones with over $7 billion in assets, but there's another $10 billion in assets that we manage as well. And by doing that and pooling interest, there's a number of cost efficiencies that come out of that activity. On the administration side, we provide administration activities to 11 pension plans and 4 employee benefit type plans. So a significant amount of business that's done with other groups as well through the province. So Vestcor Inc. is technically the company that I'll report to you from tonight. It is, as I said, owned by yourself, your plan, and the teacher's pension plan. However, it is governed by a truly independent board of directors, as pointed out here in the second bullet of this slide. This board is selected based on a skills matrix that has been determined in terms of making sure that we have a number of professional directors who are independent and who have skills that are necessary to be able to govern an organization of this type. The other thing to point out, as I mentioned, is Vestcor is a not-for-profit organization, so there's no profit motive. And it allows for us, I think, to have a much better fiduciary connection with what's required by our clients, because we don't have a shareholder that we're trying to essentially drive profits through by promoting or marketing high-priced services. We truly, in a not-for-profit type of framework, have the best interests of our clients in mind. There's a very rigorous oversight regime that the board of directors of Vestcor follow. There are a number of audits that happen, as pointed out here in this slide. There's an external national accounting firm that is used to conduct audits annually for financial statements. Also, the performance reports are audited as well through an external service provider. And from time to time, there's a number of other external business audits that can be conducted. And then finally, we also publish a very detailed annual report. So again, on the vestcor.org website, there's an annual report there that would provide a significant amount of disclosure with respect to the activities of this company through 2017. So as both Eve and Leonard mentioned, there are very strict rules and guidelines that basically help determine the investment policy that is put in place for your pension fund. First and foremost is this concept of risk, and making sure that the plan itself is focused very much on preserving capital and making sure that there's not undue risk taken place with respect to the investment activity of your portfolio. And from a legislative perspective, there's also strict risk management tests that must be filed annually and must be passed. So all of those considerations have to be taken into account when designing the portfolio to best meet the liability of the plan itself. So risk is really a primary motivator, and from there, the next piece is obviously trying to make sure that we can generate returns to meet the hurdles that Eve mentioned, the 4.75% discount rate, and trying to actually do that in excess of the 4.75 over the long-term time period. Long-term time periods being very important in this equation as well. So looking at 2017, this chart on the left-hand side shows the return. Again, in Eve's report, he mentioned that the investment return was 7.81% for the year in question. Two bars sort of can break up that 7.81%. The 6.72% is what has been earned from the investment portfolio that your plan has, the investment policy statement. And then our internal Vestcor active management activities added 1.09% additional on top of that policy activity. 2 points I'll make. Our annual report, your annual report and the Vestcor Inc. annual report as well actually has a very detailed breakdown of the various subcomponents of that return. So for those who have an annual report, if you go to page 24, you'll see there's a breakdown of a number of different asset classes and where that return came from. For those who follow investment markets closely, 2017 was a year where there were very strong equity market returns. Equity being one of the riskier asset classes. There was pretty significant gains made there. But that being said, if you look at that page, you'll see that most all the other asset classes also had a positive return, though, that took place through the year. And that blended return turns out to be the 7.81%. The 7.81%, obviously, not only that return, but the other ones that we have here over the past 4 years are well in excess of that 4.75% return that Eve had mentioned, and also the 5.9% expected return that he mentioned as well. So the 4.75% discount rate and the 5.9% expected return, we've been able to exceed that over the past 4 years. That being said, we have had some feedback from members and had some media exposure this year that did point out that 7.81% for 2017 was relatively low compared to a number of other Canadian defined benefit pension plans. Now, those typical Canadian defined benefit pension plans don't have the risk requirements, the risk mitigation requirements that we talked about earlier. So we would expect in years where there were strong risk market returns like in equities that the portfolio is going to be less than those typical defined benefit pension plans. So that wasn't a surprise to us that this return was lower for the year 2017. But more importantly, and back to that long-term concept that I mentioned, if we look at an analysis here of 4 years, we are much closer to that sort of standard pension plan return that is seen in the marketplace. So what this chart replicates is a survey that we have access to that is done by an external survey provider called RBC Investor Services, who go out and actually measure a number of defined benefit pension plans across the country. And this is actually the metric that was referred to in some of that commentary with respect to 2017. But as you can see here, hopefully, the blue square that's circled is the composition of the pension plans that Vestcor manages assets for. And while 2017 may have been a year where we were lower than those sort of median managers, over a 4-year time period, you can see that we're very close to that median manager cohort. Now, the important piece, remember, is one of the priorities is the risk management piece of the equation. Well, 2 steps, the risk management piece. So if we want to prove that we are lower risk than other peer pension plans, if you look at this chart, which measures essentially on the y-axis return on a per annum basis, and on the x-axis risk, we want to make sure that if we're actually delivering on that low risk approach, we should be on that sort of the left-hand side of that chart, which is in fact where we are. So we are delivering on that low risk requirement. The plan is passing those legislated risk management tests, but we're not, over the longer term time period, giving up a significant amount of extra value compared to those other pension plans. And more importantly, we're still more than meeting that 4.75% and 5.9% return hurdle that's required that Eve had mentioned earlier. Okay, so it's important to not necessarily get focused on any one term, 1 year time period, but look at how this works out over the long-term time period. These types of plans and the strategies inherent in them are based on a very long-term type of analysis. And then to just sort of think about that a little bit further, this just outlines the mix of assets that your portfolio has. The traditional defined benefit pension plan, the old defined benefit pension plan that many of those squares on that prior chart I showed you would be, they probably have much more of a weighting of something like 60% in public equities and 40% in fixed income. If you look at this mix, you can see that the strategy is broken up into more detail, being about 40% public equity assets. And of those public equity assets, about half of them are deployed with what we call low volatility public equity strategies that we have developed in-house and we think fit very well with these types of strategies. About 37% are in fixed income type assets. And then another 13 would be in inflation-linked type assets, things like real estate and infrastructure, where the returns that you receive are typically indexed to some sort of inflation return, and also real return bonds, which are a bond traditionally mainly issued by the Government of Canada that again pays you a return based on inflation. And again, that's important with us helping to make sure that we can keep up with inflation for the portfolio over time. And then last but not least, you can see the fourth bar down from the top, what we call absolute return strategies are strategies that we developed in-house to provide solid single-digit type returns that aren't correlated with either equity or fixed income markets, again, to help provide you with that risk buffer that you need with respect to the legislated requirements and making sure that the pension plan is sustainable over the long term. So that deals with the sort of the nominal or absolute returns that the fund had generated. But I wanted to add another slide here to dive a little bit deeper into the value-added returns. If you remember that chart I showed you before where we said that our active management activity added about 1.09% on a gross basis. And I should have maybe made that comment earlier as well. I'll just go back here just to make one point when we're looking at these investment returns, whether it's the 1-year return or the 4-year return. These comparative numbers are on what's called a gross basis, where we haven't taken into account the difference in investment management costs. And as you'll see in a further slide, there's a significant difference between what the investment management costs of your plan is through Vestcor versus using a third-party external type manager. So here again is the value added by active management by the Vestcor investment staff above your investment policy. And so you can see here on the far right this time is the 2017 numbers. And you can see it was, the returns were a little bit, this chart here shows sort of the composition of all of the Vestcor clients. Yours was a little bit higher at 1.09% of value added. And when we actually adjust for costs, which is the bar that's below the 0 point here, you ended up with 0.97% on a net basis. So you can see here that over the last 4 years, the value added that's been attributed to your portfolio and to our client portfolios through Vestcor has been pretty significant. We've been able to do a very good job in adding additional value. And that compares, if we think back to a period earlier over time, where we went through the financial markets crisis back about 10 years ago. We didn't have a lot of active risk on in our client portfolios, and therefore we didn't have a lot of additional value created, although we did have a little bit, as you can see by this chart. We've really, since markets normalized coming out of the financial market crisis, added more significant value of late, which all obviously helps portfolios over time. And then what we've done here is, on the bottom, just show what the investment costs have been over time. And while it's hard to see with the scale, the investment costs as a percentage of assets actually have been declining over time as we've been growing client assets through both investment returns, and actually we've added some new clients over the past couple of years as well. And so being a not-for-profit, this is a very powerful, again, a very powerful concept for the not-for-profit nature of Vestcor, in that we can add client assets to our portfolio but not undergo significant cost increases. So that helps move costs lower for everybody. There's a very big economies of scale concept that happens, and that isn't what happens in sort of the external management world, where costs really pretty well stay the same over time. So we've been not only having strong value-added performance, but reducing your cost ratio as well over time. One of the ways I like to think about that, sometimes when we look at these numbers and we say we've had a return of 7 or 8% and we've added 1%, people will look at that and find it hard to realize what that means. But one of the ways to think about it is as follows. So first of all, just thinking about what the returns have been for your plan. In 2017, the total investment income for the portfolio was just a little under $560 million. And that's been pretty constant. Probably if we took that 4 years that's shown there and average it out, we'd probably have a little over $500 million a year that the investment program has been adding to the pension plan. And if we break that down into how much has been from investment policy and how much has been from active management returns, you can see in 2017, a little bit less than $70 million has been from investment management, sorry, active management. And that's net of costs. So we've taken the Vestcor costs out and shown that in 2017, about $70 million came from that. And one of the ways I like to sort of equate that is, as we've sort of pointed out in this bullet, if we look at what the average pension payout was in 2017, including the bridge benefit, it's just a little under $30,000. That extra $70 million would pay just a little over 2,300 additional pensions. So again, pretty powerful numbers in terms of what it contributes in terms of providing extra pension payouts over time. And then a slide just try to make the cost, to just equate what the cost advantage has been. The investment management expense ratio for Vestcor for your plan is 0.12% or 12 basis points. I would point out, if you look in your annual report, you'll see, I think it's 13.8. The difference here is this is pre-GST versus post-GST in the annual report, so there's not an error there in the numbers. It's just the difference in terms of this one doesn't include GST, just to make it comparable with some of this other data that I have. So we had access to another survey that was done for Canadian institutional investors, and you can see one of the things that we do is we provide for more services on the investment side than just the pure investment management. We do the investment accounting, there are legal costs associated with investing, record keeping, and some trust and custody costs. So a survey of funds across the country, broken down by size of assets, would be as follows. And you have a plan that's greater than $7 billion. So we'll look at the far right-hand side here, and shows that plans typically greater than $1 billion would have total external fees of around 37 basis points, here 36.7. So that is if you were typically using Vestcor, you were going out and sourcing for-profit investment managers. You could expect to pay something along those lines. You're currently paying about 12 basis points. So the cost efficiency argument here is about a savings of about 3 times, if we think about it that way. And that 3 times works out, from your perspective, to be a little over $18 million, right? So it's a pretty significant, again, savings by using a not-for-profit entity based here in the province, using professionals that are based here, being able to save just on the cost equation side of things about $18 million. And again, I always like to sort of equate that into pensions, and that would be a little over 600 sort of annual average pension payments that would have taken place during the year. Okay? And then to wrap up on the investment side, one of the questions we always get is, well, that's the past. How's things looking this year? And so this gives a preview. I think this has been out in the most recent newsletter, but it gives you a little bit of a preview of year to date. The plan has returned 2.42% year to date. For those following investment markets, it's been a bit of a choppy year. We started out pretty well in January, and then there was a big volatility spike in February where there was some employment inflation data came out of the US, and equity markets dropped about 6 to 10%, depending on where you were at, and then sort of slowly recovered back into the mid-year time period. So considering the choppiness of the marketplace, 2.42% worked out to be pretty good. And actually, if we compared this to those prior peer funds that I mentioned earlier, we're actually doing better than the median for those peer funds. So this is another check and balance I like to do. In more choppy, lower return periods, if we're going to represent that we're not going to have returns as high in very risk-on time periods, then we better be able to show that we can provide excess returns in the more choppier periods. And if we just think about this 6-month time period, in fact, we actually did do better during that time period. Now, that's a short-term window, and we'll have to sort of see how the year plays out. But again, we are seeing in those times of market stress, this portfolio standing up much better than that sort of traditional 60% equity, 40% fixed income type market. And then just to wrap up, as we mentioned earlier, Vestcor is much more than just the investment side of things. We do provide a number of different functions. We have a pension administration team that perform the day-to-day calculation activity with respect to pensions, calculating benefits and where they stand. Also with respect to the work done there on the employee benefits side. We have a member services team. For any of you who phoned in or corresponded with questions, this would be the team that would actually help answer your questions. If you're looking for an estimate of what your potential pension might be, this is the team that will do that. And they're very active in supporting you, the members. And then we also have a team that does board support services. So in terms of helping facilitate your board of trustees, be able to facilitate meetings and do record keeping and run agendas and meetings and things like that, that group does that. And then last but not least, it was mentioned a little bit earlier, but we also have a communications unit, most of them sitting at the back of the room here this evening, who are very instrumental in providing the semi-annual newsletters that you're now receiving, putting that annual report together that we've shared with you tonight, organizing this AGM, and then last but not least, but also work on the website that we've just redesigned. I'm not sure if anyone's had a chance to access the website, but we have done a fairly significant change there as well. And on the administration side of things too, we are very cost effective compared to peer administrators. Again, particularly if you went out to the private market. In your annual report, there's a good breakdown there that talks about the cost of the administration side of things. It works out to be about 5.5 basis points. On the investment side, again, when we include GST, it's about 13.8. So the total package works out to be about 19.3 basis points, which is extremely low vis-a-vis other external alternatives. We also have kicked off, for those who have talked to our member services group, we are trying to solicit feedback on how that experience has been. So our team has a number of client satisfaction surveys that they've been using with respect to getting feedback on services and where that can be enhanced. So some of you may have already experienced that. We've talked about the website. I'd like to think it's a much better improved version rather than having to go search through the GNB, Government of New Brunswick website to find your pension plan and the various documents. It's all there accessible through the vestcor.org website. We've also upgraded our pension estimate calculator. So those who are close to retirement probably have used it, but there's a number of ways you can take your pension statement and put various scenarios in with respect to your remaining work life and try to figure out what your potential benefit will look like going forward. We'd like to think that that's been enhanced greatly and is much more easier to use. And then last but not least, but an important piece that's happening more behind the scenes is a modernization of our administration system, where we're essentially looking to upgrade our administration system to provide much more timely data, have increased security, and potentially bring some additional cost savings to bear on the organization. So there'll be more on that probably at this meeting next year. So that wraps up what I had to share with you with respect to Vestcor in 2017. But like Eve and Leonard and the rest of the group, we'll be here for questions. Thank you.
Thank you, John. And the board has certainly been pleased with the continued positive integration changes that we've seen at Vestcor in the last year. Your plan, along with the teacher's plan, are co-owners of Vestcor. And so, as you saw in the slides that John presented, you know, when we benefit from lower fees and still are getting the kind of service that we're getting, I mean, that's been good for the plan. So we say thank you to Vestcor. And thank you, John, for your presentation tonight. At this point, we'd like to move into the question and answer period in case you have any questions on anything you've heard here this evening or questions around the plan. We have microphones here in the middle aisle for those of you who are here in the room. If you're watching online, you can submit your questions by clicking on the question mark that appears on your screen. And we'll start out. Susie will come and monitor this part of the evening. For some of you, just want to caution, if your question doesn't get answered tonight, if we get a lot of questions online, and we've already had some, we have committed to answering those and putting them on the website in the coming days. So not to worry if it doesn't get answered here tonight. But Susie, I'll ask you to come and conduct this session, please.
Merci, Marilyn. Good evening, everyone. Bonsoir tout le monde.
Good evening, everyone.
Ici avec vous ce soir.
I'm really pleased to be here with you this evening in Bathurst. And as Marilyn mentioned earlier on, my name is Susie Prudaigle, and I'm a member of the Trustees Board and of the plan as well.
Or our guests who have presented to us this evening, please make your way to the microphone now. If you're watching online, you can submit your questions by clicking on the question mark, as Marilyn stated, that appears on the upper left-hand corner of your screen. In addition, we do have many members who have submitted questions online prior to this evening's meeting, and we're going to attempt to answer as many as we can. However, if we don't get to your question tonight, please check the website in the next few days, and we are going to attempt to put those questions and answers there. So seeing that there's no one at the mic right now, I'll move on to the first question here that we have, and John, it's for you. We've received a few questions with respect to how the incentive plan works at Vestcor and how it's tied to the investment performance. Can you please elaborate on that?
Sure. Thank you, Susie. So I think it's first, before I get into answering the question, I would just point out again, I referred to the annual report for Vestcor Inc. that's on the Vestcor website. There's a significant amount of disclosure and discussion with respect to compensation policies and processes there for those who really are interested in the detail. I think to answer your question, compensation is extremely important and is something that our board takes very seriously. It's designed, from the investment side of things, it's designed to be able to attract and retain knowledgeable, experienced personnel to be able to manage $17 billion in assets here in the province and in our office in Fredericton. $17 billion is a very large pool of capital. You may be familiar with some peer funds like Ontario Teachers Pension Plan or Canada Pension Plan. They have hundreds of billions of dollars. But if we go down below those big public sector plans and look at other even for-profit managers, a pool of $17 billion is quite important. So being able, again, to make sure that we have the right staff to be able to manage that's important. From the industry's perspective, incentive compensation is a large part of the compensation equation. The idea is making sure that performance of investment staff is aligned with the compensation. And so typically, the industry has a relatively, for senior staff particularly, has a relatively stable base salary level, and then an incentive plan that's based on providing investment performance. And a large part of that is weighted on how well we have done versus benchmarks. So if you think back to the slide 38 that I mentioned, you can see that over the last 4 years, we've had very good performance versus benchmarks. And that, as well, the performance isn't just based on any 1 year, it's based on longer term or 4-year cycles. So seeing that the industry basis is to have that tie to performance, and our performance has been relatively strong, that equates to the compensation that we've sort of more recently published. I think the other thing to point out is, as I mentioned earlier, it's a very important element that our board looks to. Our board has a specific human resources and compensation committee that spends time on this and has access to a number of external advisors to make sure that, in fact, the program is following those best practices and is comparable to similar firms across the country.
Thank you, John.
You're welcome.
Yves, next one's for you. And I'm going to ask people in the room, ceux qui sont dans la salle, gênez-vous pas, les micros sont...
So please don't be shy. If you're in the room, you have questions, please go to the microphone. But the question is for Yves.
Reports on the Consumer Price Index year over year. For June 2018, it's 2.5%, a full adjustment, not 1.88%, which interestingly corresponds to 75%. The Pension Coalition is very concerned with this misleading statement for all 38,000 members of the plan, and will seek clarification and address this issue. Is CPI calculated any differently now under the shared risk plan than it was at any time prior to conversion?
Thank you, Susie. The calculation of the Consumer Price Index, just to answer the last part of the question, is not different right now than it was when it used to be called the Public Service Superannuation Plan, so the PSSA. What the June 2018 number of 2.5% is the monthly CPI. CPI is published every month. However, you receive it only once a year. You get your increase once a year. So what we do to determine the annual increase is we take the average of what's published in every month for the year ending June 30th, 2018. So on June 2018, it was 2.5%, and then we take that, but we take also the April one and the May one and the March one going backwards like that for 12 months, and we average those over the 12-month period, and that's what gives the 1.88%. So having said that, now that at June it's 2.5%, in July the published one was 3%, and it was one of my comments in my presentation. If we stick for the following year, or starting from now, to more like 3%, then that's what you're looking at in terms of an indexing, but that would be Jan 1, 2020, and not the one at January 1, 2019. So at January 1, 2019, we're at 1.88, and it's the average of all those monthly rates for the 12-month period.
Thank you, Yves. Next question is going to Marilyn. Under the costs related to the operation of the board in 2017, we see an increase of more than 100% compared to 2016. I'd like to see an explanation of the increase of almost 100% on per diems.
Thank you, Susie. In the annual report on page 9, it refers to the per diems, but for the interest of those, in case it's not clear there, in 2016, only one of the trustees on the board qualified for per diems. In 2017, we were fortunate to add new trustees to the board, and now we have 4 trustees who are claiming per diems, so that accounted for the increase. Originally, in 2016, we had 1, but now we have 4 people. And you can see there it explains that it's $250 a day is the per diem, and it's outlined there. So that's why there was such a jump from year to year.
Okay. Thank you, Marilyn. Leonard? With the provincial debt now at $14 billion and growing, and a New Brunswick population of approximately 750,000 to pay for this debt, it's financially extremely challenging to pay our growing debt. I would like to know if our pension plan is protected. What happens to our pension plan if our province ever goes bankrupt? or is faced with an end of financial support or even a management taken over by lenders?
Thank you for the question. First of all, these assets of the plan that we've referred to, the fund, these are assets that belong to the plan members. These are not assets of the province. The province's only obligation is to contribute the amounts that are contained and required in the plan text. Once the province makes those deposits, and they make those monthly into the fund, those are held in trust by the board solely for the benefit of the plan members. So in the unlikely event of any sort of financial restructuring of the province's debt, the assets of this plan and monies that are put aside for plan members are unavailable to the province or the creditors, as I said, in that unlikely event. These are assets that belong to plan members.
Thank you. Est-ce que quelqu'un dans la salle qui aimerait te poser des questions?
Anyone in the audience who would have questions? No? If not, well, I'll continue with those online.
Yves, when we retire, why is it that we cannot just take out our pre-shared risk portion of our pension and leave our shared risk portion alone until we decide to take it? For example, at the age of 65. You have to figure out both amounts anyway, so it doesn't make any sense at all why we can't do this. I know several organizations, such as the City of Fredericton included, that they can split their two amounts and take them at two separate times. I think that this is totally unfair to employees. Shared risk was forced on us, and now you are forcing us to be heavily penalized should we wish to retire before the age of 65.
Thank you, Susie. Just like I mentioned in my presentation, so you will have seen at the end of my presentation a calculation of early retirement reductions, and we were showing here's your pension accrued before January 1, 2014, and here's your pension accrued after January 1, 2014, and we were applying different reductions if you wanted to retire early for the period before 2014 versus after 2014. And those after 2014 are bigger reductions because the pension after 2014 is really only payable in full at age 65, whereas the pension before 2014 is payable in full at age 60 and is only reduced if you retire before 60. So what's being asked here is, can we start the pre-conversion pension right away when we retire, because we won't be reduced a whole lot, and just wait to get the other part of our pension starting at age 65, and that way we don't have to suffer the penalty. I hate the word penalty. The reduction in pension is there for a purpose, and it's only because you're getting the pension for a longer period because you're retiring early. So to be cost neutral to the plan, there has to be a reduction in the pension because in my example, the person was getting it for 6 more years, retiring 6 years early. So this is a nice question. Some plans, like the City of Fredericton was mentioned, allow people to do that, whereas this plan doesn't allow to start the pension one side before the other. It's a question that the trustees could look into. Certainly, it's an amendment that is cost neutral to the plan. The plan is somewhat indifferent whether you start your pension from a cost perspective, whether you start it at 59 reduced or at 65 unreduced. And so the only issue here is that it is much more costly to administer. It makes everybody's pensions in two pieces, and people starting it together, people not starting it together. So administratively, it represents a significant amount of additional money in order to do it. The other issue is that for people who have, or plans that have offered that, what I'm being told is that the pickup of that option is actually very, very low. So not very many people elect to start their pension, one side of their pension before the other side of their pension. So it's a lot of money administratively for a low pickup. But it's certainly a question that the trustees could look into.
Okay, Leonard, did you want to add something?
Yes, I do. In fact, this issue was brought to the board's attention by one of the trustees recently, and it is on our emergent list of issues to be researched. And in fact, I note that it is already in progress. We're looking into the matter. It's an interesting request, but it will take a little time to research, but it is on our work plan.
Thank you. For those of you watching online, certainly if you have any questions, we'd encourage you to send them to us. Right now, as it stands, right now I have about 2 or 3 questions. So if we have nothing, then we would be closing the meeting. So hopefully people will send us more questions, or you'll get up and ask some questions as well. So this one's for Eve. Why did pensioners not get a full COLA, cost of living allowance, in 2017 and 2018? The CPI was 1.9%. Increases were only 1.45%.
There was a full COLA on the way we calculated it, and I'm not sure where the 1.9 actually comes from exactly. Last year, if I look at the June number, comparable to the 2.5 I just talked about, but for last year it was actually 1%, and then the average over the year was 1.45, and so that's what was given. I'm not sure where the 1.9 comes from, but the calculation has never been different. It has always been the same, and it's the average of the CPI over the year for all the months up to June 30th, and you have received full CPI since the onset of the shared risk plan.
Thank you, Eve. Next one's going to Leonard. So Appendix D, the first page says, the board maintains systems of internal control and supporting procedures to provide reasonable assurance that accurate financial information is available, that assets are protected, and that resources are managed efficiently. What are these systems of internal control? Do you want to answer that, John?
Are you okay with that, Leonard? Okay. Thank you, Susie. So there are a number of, I guess, items of control. Some of them had come up with the earlier presentation that Leonard put together. Things like the funding policy that's set out for the plan and the statement of investment policies. Both of those actually are very important documents that are filed with the Superintendent of Pensions and are a regulatory requirement. The board also, so with respect to the relationship with Vestcor, they have a administration agreement and an investment management agreement that both set out a number of various requirements that they have in terms of service that they want from us with respect to both of those types of functions that we adhere to. They also have an agreement with Eve at Morneau Chapelle that does something similar. And monitor the relationship there over time as well. We talked about audited financial statements at Vestcor. Well, as per your annual report that was handed out here this evening, there is an independent auditor that is engaged by the audit committee of the Public Service Trustee Group. It's KPMG in this case. And they, through the audit committee of your pension plan, use that external auditor to audit the financial statements and make sure they're in accordance with things like the various accounting principles that are necessary. And then last but not least, Vestcor ourselves has a system, a very detailed document that has a system of internal controls that we use that we actually do share with the trustees and with the auditors as they go through their audit regime to make sure that they can use those controls and test some of those controls over time as well.
Okay. Thank you, John. On va aller au micro numéro 2, s'il vous plaît.
Merci, Suzy. Michel.
Mic number 2. Thank you. Mike Robichaud, the CCNB Bathurst here in New Brunswick. Thank you very much for having come here this evening to Bathurst for your AGM. I have a question, and it might be my own point of view, but if I just think back to the financial situation of the Canadian households, we're talking about figures that are going up very high. And it's my point of view, but I think if expenses keep going up, we're going to end up in a financial crisis similar to what we saw in the States some 10 years ago. The same type of difficulties for households. Are our funds protected if we were to have that kind of financial crisis here in Canada?
You know, the tough I guess the tough part of answering that question is no two financial crises are the same, so it's hard to estimate what that might look like. However, hopefully what I demonstrated when we looked at sort of the return profile in terms of performing better in the market downturns and how diversified your portfolio is across various products does provide that degree of comfort that we are better protected. Certainly, if a financial crisis happens, there will be an impact to plans, but I would suspect that, and would expect that it would be less than what would happen to other more traditional defined benefit plans that had more risk inherent in them. And when you think about the testing, as Eve pointed out, the various stochastic testing that takes place to make sure that there is a certain probability of base benefits and a certain probability of a percentage of cost of living being paid, at least that testing as well provides an additional level of comfort because the numbers that are being used in that testing does incorporate scenarios that would incorporate past financial market crises and such. So, the idea from, again, how these portfolios are built is that they are really built to be able to perform much better in those types of environments. When we've seen periods, the shared risk plan, your shared risk plan's only been around for 4 years, as Leonard introduced, but when we have experienced periods of volatility in that 4-year time period, and to date, the portfolio does perform much better than other more traditional portfolios in those times of stress. So again, that provides us with some degree of comfort that we should be in a better position, again, though, with the caveat that you never quite know what this potential crisis might look like.
John, this one kind of relates. I'll ask it. What's being done to reduce the risk in the event of a market downswing?
So again, I think it really depends first and foremost with how that policy's been developed. And then what we do is we have a number of internal tools where we continue to look at where we can forecast the risk of that initial portfolio. And as markets transpire, we can estimate whether that risk is going up or down and try to make some informed decisions around that we will then, if we think something needs to be done, we can talk to the trustees and think about that from an investment policy context perspective. So there is the ability to do that. But for the first and foremost a point of defense is really the construction of the portfolio itself.
Thank you. On va aller au micro numéro 2, s'il vous plaît.
Mic number 2.
Recently retired. You compare the pension, the cost of the administration for the pension plan with private sector providers. Would it be more appropriate to do this in comparing it to other provincial pension plans?
Yeah, very good question. And we do actually, one of the things that is very helpful in our business on the administration side and on the investment side is to basically benchmark and dialogue with our similar colleagues in other provincial jurisdictions. And we have, through that activity, determined that we are on the lower end of that cost scale. The places where we aren't as cost effective are if we compare ourselves against really large plans like the big Ontario plans, because again, the cost efficiencies or the economies of scale are so significant there that it's hard to match with some of those. But when we look at ourselves across the country for similar size plans in terms of the number of members and the number of plans administered, we would be on the lower side of that as well.
Would it be appropriate to partner with other larger pensions to diminish your costs and perhaps increase your rate of return?
Well, that's in fact what we're doing in a New Brunswick context right now. So for example, as I mentioned, we have 9 various investment client groups. So we are on the investment side using those cost efficiencies. On the administration side, there is the ability for us to do that in the future. One of the pieces that I mentioned we're working on is this new administration system upgrade that will help us potentially look to do that in the future. So that is something that will provide us with the ability to try to continue to do that over time. The issue is, if you're thinking about it from a national perspective, is that there's just unfortunately so much nuanced difference between plans across the country. So for example, every plan does have a different sort of has different nuances in terms of how the pension calculations actually work and service, that it's not quite as easy to make that happen. But it's certainly something to think about over the longer term. Right now, we're just focusing on trying to do that with public sector plans in the province, and we are realizing pretty significant economies of scale, hopefully, as I showed through the cost effectiveness that we've seen over time.
If I may interject, I think in some cases on the investment side, you do partner with other large funds across Canada, again, not just to get costs down, but to seek similar opportunities.
Yeah, certainly. I was thinking on the administration side, I think where your question first came from. But on the investment side, you're right, Leonard. So one of the attractive pieces of us growing our asset pool on the investment side I mentioned was the actual reduction of or spreading of the investment management fees over our various client groups. But the other thing is, as we look to invest more in real estate or infrastructure or private equity opportunities, we have, as Leonard pointed out, done a pretty good job of being a co-investor with some of our larger peer pension plans across the country. So one of the ones that's publicly known is, you may have read at some point in time that the Canada Pension Plan Investment Board owns the Highway 407 toll road in Toronto. They bought that out of the financial market crisis, from a large part of that asset out of the financial market crisis. They looked for some partners to co-invest with, and we were one of them. So actually your plan does have some exposure to that Highway 407 toll road. So being able to be seen as a peer plan who's interested in investing in those assets and holding them for a really long time to immunize a liability like we are, we can be seen to be attractive that way. So that we are seeing those economies, as Leonard mentioned.
Okay, thank you, John. Micro numéro 1, s'il vous plaît.
Hi, Marilyn, you mentioned in your, my name's Anne-Marie Morin, I'm retired, and you mentioned in your opening statements about the legal action and that the plaintiffs were looking to be repaid their legal fees to either the pension plan or the province. My question was, where do the legal fees come out of for Vestcor or your side of it? Is that coming out of our pension funds or?
Thank you for your question. The funds that the board has engaged a lawyer, and those funds are coming out of to pay the lawyer is coming out of the pension fund. And that was to protect the fund from even larger costs that the lawsuits are looking to gain from the fund. So yes, indeed, we sometimes have to pay money so that we don't lose more money in the future. But that money is coming out of the fund.
Okay, so basically our pension funds are being used to fight off the other pensioners.
No. What I would say is that your pension fund, some of it, a small portion, is being used to engage a lawyer to make sure the interests of this plan are protected and to prevent someone from, going to, well, they're in court, other cases, but to say that if the province won't pay for those people, well, we'll just tell the plan to pay. So we're trying to protect the plan from that happening. So we've engaged the services of a lawyer, an expert in that area, to protect the plan.
Okay, and are those costs reflected in our financial statement that we're looking at, or where would we see that?
Yes, they are in this statement.
Okay, and it would be indicated under legal fees, I'm
Yes,
assuming.
Yes,
okay?
I believe so. We can find out before you leave tonight exactly
Okay,
where it
great,
is.
thank you.
Page 25.
Okay,
Thank you.
So Eve, another question for you here. Nice to see the shared risk plan doing well, this being contrary to what was delivered to employees back in 2013 and 2014, when it was decided to move retirement age to 65 instead of 60 with a 5% penalty per year before age 65. Could you please explain why this 5% can't be reduced or eliminated with new numbers of the plan valuation? Why would retirement age of 65 not be reduced or revised?
Thanks, Susie. That's a good question. Removing or reducing the 5% completely would allow people to retire earlier with an unreduced pension, which would increase significantly the cost of the pension plan. So that's one of the things that the Board of Trustees is actually not allowed to do under the funding policy. So we've alluded to the funding policy throughout the night. Leonard has talked about it. It's a document that tells the Board of Trustees what they can do or cannot do, or what they must do. So in the case where the plan is in a surplus position like it is right now, it was decided by the parties who created the plan that first and foremost, indexing had to be provided. And so that's why the money is there, first of all, to provide indexing instead of changing plan benefits, other plan benefits. Not that it could not be done in the future, but the financial status of the plan at this point in time is not such that the Board of Trustees can look at such type of benefit improvements. There would be, first of all, when the ratio that's at 129 today would have to be above 140% before contribution reductions would be the first thing that would happen. So active members and employers could benefit from a small contribution reduction. Then after that, under the funding policy, if the plan is still in good financial position, then you have to build a reserve to provide indexing into the future. And then after that, then the Board of Trustees can recommend some changes to the parties, the province and the unions being the parties, in order to consider potential changes in benefits. It's only at that time that such a provision could be changed. But we're not there yet. We're at 129%, and the funded ratio should be well above 140% before that can be considered by the trustees.
Thank you, Yves. We did get a question, do you post a recording of this session on your website? And I can answer that one. Yes, next week on the plan page, it'll be on the Vestcor website, and that address is Vestcor, vestcor.org/NBPSPP. And in French, it's Vestcor as well, VASTCOR.
Vestcor.org/ and in French, RRSPNB.
One last question, unless there's a line up here. How are pension surpluses being handled post-2014 versus pre-2014?
The surpluses in the plan post-2014 stay in the plan. They belong to the members. So there is, as a result of the surplus that accumulated after 2014, you can be provided indexing with that, okay? So there's nobody that's going to come and claw back these surpluses in the plan. They belong to plan members. They're assets of the plan. Before 2014, if there were surpluses in the plan, they would potentially stay there. There could have been a reduction in contribution by the province to make these surplus go away over time, but that's no longer the case. Now the surpluses are to members. The reduction in contribution is only at a much higher funded level before it happens, and it's not only the province, it'll be the members and the province that will have a reduction in member contributions. So in a nutshell, I guess that kind of summarizes it.
Merci, Yves. Nous allons maintenant...
So we are now going to wrap up the question and answer period for this evening. But please note, if you do have any questions that you weren't able to ask tonight, you can still do so by email or by mail. Furthermore, the board members will remain here for a certain amount of time after the meeting in case you have questions you'd like to ask them directly. Before you leave, though, I'd ask you to take a few moments just to answer and fill out the feedback that you got when you came in. If you follow us online, tonight, the feedback form will be sent to you by email tomorrow, and your feedback through this brief questionnaire will really be very important for us. And on behalf of the Board of Trustees, I'd like to thank you for your participation here this evening, whether you're here in person in Bathurst or whether you've been following us online. I'd also like to thank all of the presenters here this evening, those who came here to join us this evening, as well as the Vestcor teams who are sitting at the back of the room that was responsible for the organization of the meeting.
Annual general meeting. Oh, thank you, translators. Thank you for all your help here tonight. Thank you, everyone, and have a wonderful evening and safe travels home.